Welcome to our fourth unit on recording financial transactions. In this fourth unit, we are going to look at completing ledger accounts and financial statements. Completing ledger accounts and financial statement. So in this unit, we are now looking at the key accountancy skills that are required to produce financial statements from the ledger accounts. When we started recording financial transactions, we said there is a process that we follow when transactions take place from inception until when financial statements are prepared. The process started with the source documents, and then from the source documents, the transactions are now posted in books of prime entry or day books. From the day books number 3, we are now posting the transactions to the ledgers, whether it's a general ledger, it's a receivables ledger, or whether it's a payables ledger. That was the third layer. And then the fourth layer is now just to check the arithmetic accuracy through what we call the trial balance. And then the last layer is now preparation of financial statements. However, if you are sure that your records are correct, we can skip the stage of trial balance by going directly from the ledgers into financial statements. But that is not always advised, because in accounting there is what we call verifiability. So let's have a look at what we'll cover in this unit. Number 1, we'll see how do we balance ledgers, but we'll be looking at introduction to it. Number 2, we'll look at the concept of the trial balance. Number 3, we'll look at the concept of journals that are used to make corrections. Number 4, we'll look at what we call errors. And number 5, we'll look at what we call financial statements. So let's start with number 1, balancing of ledgers. Take note that a ledger is a T account. For example, when we make sales in credit to maybe Solange, sales in credit to Solange, and the sales maybe it is worth 200,000. There are 2 ledgers we will prepare. There are 2 T accounts we will prepare. Remember, we said for every transaction, there is a debit entry and there is a corresponding credit entry. So, number 1, you will post what we call a receivables account, and the receivables is specific. It is a personal account, Solange account, and that Solange account we will debit. We will debit 200,000. And the corresponding credit entry will be posted in sales account. Sales account, it will be a credit entry of 200,000. 200,000. Now the point is we need to name the posting. So in the receivables account, we give the name of the other account. For example, if in the receivables T account, the other account affected is sales. So here we'll come and post what? Sales. This is a sales account. We post the other name of the other account. This will be what? Receivables. But in a transaction, there should be a date. Maybe the transaction took place on 5th of May. So if the transaction took place on 5th of May, we can write 5th of May there. We can also write 5th of May. We can post that. And then we also need to put what we call a reference or a folio number. This can be our transaction number 1. So we can come and have transaction number 1. We come and have there transaction number 1. This is an example of a ledger. So maybe in a month we have 10 or 5 transactions that affects receivables and affects sales. So maybe there is another account, there is another amount of maybe another transaction that affects that 100,000. Maybe it also affects this. I'm just using this as an example. Maybe there is another payment that was made. Remember, another payment that was made by the customer. We sold goods to a customer. Maybe out of that, the customer has paid us. Maybe the customer has paid us 120,000. So if the customer pays us 120,000, we will close these receivables. Sorry, we will reduce the receivables by 120, and we open another account, which we can call it. We have closed that, and we have what? Cash account. So we have now received 120, and the 120 goes to our cash account. So in this case, this account is cash. So here, maybe the date was 6th. I'm just guessing the date. 6th, you'll come and have 6th May. And the transaction here is cash. And here, the account is called what? Receivables. But remember to give the reference number. Maybe it is transaction number 3. It is transaction number 3. That is how we open ledgers. And all ledgers must have debit and credit. All ledgers must have debits and must have what? Credits. That is what we are calling ledger accounts. Now, in our ledgers, at the end of an accounting period, a balance is struck on each of the accounts in turn. What do we mean by that? At the end of the month, we come and get the total of the debit side and the total of the credit side. We record the highest figure. For example, this is 200,000 and this is 100,000. But on the credit side, it's 120. We record the highest value. So our highest value is 300,000. So that highest value is what we record, 300,000. And then, once you have recorded the highest value, you get the difference, the shorter side. The shorter side was the credit side. Remember, this was credit side. So this was 300, but this was 120. So it means there is a difference of 180. This 180, on the last day of the month, we will call it balance carried down or balance carried forward. So this is what we call balance in the ledgers. This is what we call closing the ledgers. And this balance, the difference between the debit and the credit side, is what we call balancing the ledgers. To our statement, at the end of an accounting period, a balance is struck in each account in turn. In each account in turn. So you finish with receivables, you go to sales. Sales will also have a number of transactions. Maybe sales, I'm just guessing figures. Maybe here it was 50. So in the sales, you will strike, you'll close it 300,000, 300,000. But now in sales, you realize the balance is 250. So on the last date, on the 30th of May, you will have balance carried down. Depending on the nature of the transaction, the balance can either be on the debit side or the credit side. This means that all the debits on the accounts are totaled, and so are all the credits. So you get the totals of the debits and the totals of the credits. Take note of point number 1. If the total debits exceeds the total credits, if the total of the debit is more than the total of the credit, there is a debit balance on the account. What do you mean by it? If the total of the debit is more than the total of the credit, it means debit was more than the credit. So the balance is a debit. Because the debit side was, we are not talking of where you are recording the balance carried down. It means the debit side was more than the credit. The balance is a debit entry. It means that we have more in the debit side. If the total in the credits this second example. If the total in the credits exceeds the debits, so if the total in the credits 300 exceeds the total here was 50, it means then the account is a credit what? Balance. It means the credit is more than the debit. So the point in these ledgers, the point is this. Every transactions, you can find that in a month you have 100 transactions. You must look through each transactions one by one and know what do you debit and what do you credit. The key point is every transaction must have a debit and a corresponding credit. And then once you have posted all the entries correctly in the ledgers, you get the totals of the debit side and the totals of the credit side. And then you get the balance carried down. And then we have said if the totals on the debit are more than the totals on the credit, it means that there is a debit what? Balance. But if the totals on the credit are more than the totals on the debit, it means there is a credit balance. Now, once you have closed the ledgers, let's go back to these. These were our ledgers. Let's assume we have 20 ledgers. That's just an example. This is 1, 2, 3. Let's assume we had a ledger on purchases, a ledger on sales, a ledger on cash, a ledger on bank, a ledger on rent as an expense, a ledger on electricity, all these ledgers. These balances in each of the ledger accounts, all those balances, we now go and post them in what we call a trial balance. So the closing balances from the ledgers are removed from the ledger accounts and taken to what we call a trial balance. A trial balance is used to test the arithmetic accuracy of our postings before we prepare the financial statements. So it is used to check if our posting in the ledgers were correct, if they were accurate. A trial balance is a list of what? All ledger balances. A list of all the ledger balances. So there is a balance in the receivables of 180. There is a balance in the sales of 250. So it's a summary of the balances from the ledger accounts. And this summary of the balances are shown as either a debit or a credit entry. The rules of thumb are these. In a trial balance, all assets, ledgers related to assets will be posted on the debit side of the trial balance. All ledgers relating to liabilities will be posted on the credit side of the trial balance. All ledgers related to expenses will be posted on the debit side. What I'm trying to say, if we have a trial balance will have two sides. There will be a debit side of our trial balance and there will be a credit side. But you list the transactions individually. The point is, any ledger related to an asset, we post it on the debit side. Any ledger related to a liability, we post it on the credit side, credit. Any ledger related to income, we post it on the credit side of the trial balance. Any ledger related to an expense, we post it on the debit side of the trial balance. Any ledger related to capital, we post it on the credit side. But these transactions are posted individually. What does that mean? There can be several assets. There can be maybe an asset on PPE, property, plant, and equipment. There can be an asset on motor vehicle. There can be an intangible asset. All will be posted on the debit what? Side, so long as it's an asset. And then in this case, you come and now have your totals. If all your ledger postings were correct, the total in the debit side should be equal to the total on the credit side. In our next slide, it's just a sample of these. We don't need to, these are just individual entries. For example, bank is an asset. You do what? You debit. Sales is income. You credit. Purchases is like an example of an expense. You debit. Receivables is an asset. You debit. Payables is a liabilities. You credit. Capital is part of equity. You credit. Fixtures and fittings are assets. You debit. Rent is an expense. You debit. Delivery expense, so long as it's an expense, you do what? You debit. Drawings of goods, drawings reduce capital. So a reduction in capital, so if we have drawings reduce what? Capital. So if capital was a credit, drawings will be a debit. It does not matter in what order the various accounts are listed. You can start with any of the items. The order does not what? Matter. So that is an example of a trial balance. Now sometimes we make entries when you are preparing ledgers or when you are posting ledgers or when you are getting the balances of the ledgers. These mistakes that we make are, if they are to be corrected or if there is an adjustment to be made, the adjustment is made through a journal. So a journal is basically used for adjustments or correction of errors that may have been made, because human being is prone to error. So maybe you are very fast in typing. Instead of typing 1 million, you typed 100,000. And then later on you realize when you are reviewing. So in that case, you opening what we call a journal. Journals are used for, you should remember that one of the books of prime entry is a journal. A journal keeps a record of unusual movement between accounts, and it is used to record any double entries. An example of a journal is this. Let's assume there are 6 transactions that need to be corrected. So a journal will also have a debit and a credit side, just like a trial balance. But journal looks at each transactions individually. So for example, in a journal, we'll have the date, what we call a narrative. We will have debit and what? Credit. But here we can add the transaction number also. So remember, in due course, the ledger accounts will be written up to include the transactions in the journal. A narrative explanation must accompany each journal entry. So at the end of these, there was an account to be debited, which we posted there, an account to be credited. And then you come with a narrative to explain the kind of transaction. Maybe there is an item that was omitted. So if there was an item that was omitted, the narrative here will be correction of error of omission, because there was an item that was omitted. So a narrative explains what you are correcting, or explains the mistake that was there, or explains the nature of transaction that you have been given. We have an example to enable us post the journal entries. The question reads, the following is a summary of the transactions of Eve hairdressing business, of which he is the sole proprietor. The following is a summary of transactions of Y hairdressing business, of which Y, who he, is the sole proprietor. He is the owner, is the sole proprietor. So the transaction number 1, what does it read? 1st January, they put in cash 2 million as capital. On the same date, purchased brushes and combs for cash, and purchased hair dryer from Z on credit. And then next, 30th January, paid 3 months what? Rent. So I'll have a number of journal entries. Now, we have said in our journal posting, there should be a column for date. There should be a column for, this is N, narrative. There should be a column for debit, and there should be a column for credit. In a correct journal entry, those should be our columns. Those should be our columns. So this is a posting of a journal. So the first date is 1st January. So on 1st January, what took place? In the 1st January, put in cash of 2 million as what? Capital. So in this first transaction, there is the cash received, there is a cash account, and there is the capital. So cash was 2 million, you will debit it because it is an asset, and you credit 2 million in the capital account. The narrative in this case will be posting. The narrative in that case will be posting of the cash received from capital. Next transaction on the same date, purchased brushes and combs for cash 50. Purchased brushes, and so there is the brushes and combs, and there is the purchase for cash, the same date. So the purchase for cash, and how much was that? 50,000. So you debit 50,000 and you credit 50,000. So the narrative in that case is purchase of brushes and combs for cash. Purchase of brushes and combs for cash. Remember, this is transaction number 1, transaction number 1, transaction number 2, transaction number 2, transaction number 3, purchased hair dryer from Z on credit. So this time it is on credit. Purchased hair dryer from Z on credit. So here we have purchases of hair dryer. If this is an non-current asset, you will call it a hair what? How do we write dryer? Hair dryer, and it was on credit. So there is a payables, and the name of the purchase from Z. So it is Z. So this is transaction number 3. Transaction number 3. So it is how much? 150,000. 150,000. We have that. That is, again, that is the narration will come there, and you can give the narration purchase of hair dryer on credit. So we are done with the transactions on 1st January. And then you come to transactions on 30th January. Transactions on 30th January, there were 2 transactions. Paid 3 months rent to 31st March of 300,000. Paid 3 months rent. So there is rent, and we are assuming it was paid through cash. So cash is reducing and rent is is being paid. So rent is an expense. So if, for example, you don't know how to post rent, but what you know is cash. If you paid 3 months rent, it's a payment. So cash is reducing. So start by posting what you know. You know that your cash is going down. So if your cash is going down, you reduce the cash by crediting. And then the other account will automatically be a debit. For example, here, you knew that there was cash, but you didn't know where to post capital. You start by posting what you know. You received capital through cash. So cash is coming to the business, you debit. So here you credit cash. Where is it? 30th. Paid cash of, cash is reducing. 300 what? 1,300. So always start by posting what you know before you go to what you don't know. Next, collected and paid in takings of 600,000. Collected and paid in, this is what we call a possible contra entry. A contra entry is what affects cash and bank at the same time. Cash and bank at the same. So collected cash and paid in taking, or you have collected cash and paid some expenses from the cash that you had collected. Collected and paid in takings. So in that case, there is an expense that was paid. So there will be in takings and there is cash. So the cash that was collected was used to pay the in takings in that case. Now you are done with 30th. And then you repeat the same process for 31st. 31st, which month? January. 31st, January. We are winding up on that. So 31st January, we have our debit and we have our credit. Gave MX a PAM, highlights etc. on credit. So he gave a now a receivable because you gave it something on credit. It's a receivable. So you expect to have some receivable. Now the receivable, the name of the receivable is Mr. what? X. Mr. X. So you expect to receive what? How much is that? 8,000. And there will be 8,000 credit entry, which we don't know, but we can read it through that. Gave Mr. X a PAM, highlights. So PAM what? Highlights. On what? Credit. So if it's gave him on credit, so if you give somebody something, you've sold to somebody something on credit. So if you sell in credit, it means there is a receivable. If I sell to you in credit, it means I've sold to you, but you have not yet paid me. So you will pay me at a future date. So that's a credit transaction. So if it's a credit transaction, you gave me something maybe through sales, and you have not paid. You know, if you paid me, I'll debit cash. But you have not paid me. So what do I debit? I debit receivables. And you must give the narration. Being sales in credit. Being sales in credit. So all those double entries have been posted there. The next slide. So it's the same example that we have solved. Let's now go to correction of errors. Journals can also be used to correct errors or to correct mistakes. We can use journals to enable us correct errors. So the journal can be used as a record of correction to errors that have been made in writing up the general what? Ledger. For example, if an expense relating to electricity had been recorded in the gas account rather than electricity, so maybe there was a transaction related to electricity. But instead of us posting it in the electricity account, we posted it in the gas account. We need to correct that mistake. The error can be corrected. Remember, if it was in electricity, we posted it in gas, we were supposed to be debiting electricity, but we debited gas. So you will remove the gas which was debited by crediting the gas to remove it, and then you post the correct entry. And then the narration must also be given. The narration must also be given. we have said journals are used to correct errors. So let's look at types of errors. Error is a mistake. Error is a mistake that has been done. So errors can occur for a number of reasons. Accountants need the ability to understand how errors have been made, corrected through journal entries. Errors are corrected through journals. We have seen what a journal is. A journal is used for adjustment. A journal must have the date, narration, debit side, and credit side. So it can be used to correct what? An error. If the two columns of the trial balance are not equal, there must be an error in the recording the transaction. There must be an error in recording transactions. There are two types of errors. There is errors that you make and the trial balance will still balance. And there are errors that you make and the trial balance will not balance. Which means there are some mistakes you make, but your account still balance arithmetically. But there are some mistakes you make which affect the balancing of the trial balance. There are two types of errors. Errors that do not affect the list of account what? Balances. Those are errors that do not affect the trial balance. Errors that you make and the trial balance will still balance. And on the other hand, we have errors that affect the trial balance. Errors that you make and the trial balance will not balance. Which is important? It's important to know the errors that you make and the trial balance. Errors that do not affect the trial, errors that you make and the trial balance still balances. That is where it's very sensitive, because you will see your trial balance is balancing, but later on you find there is an error. So you must be keen about the types of errors. There are about 6 or 7 errors that do not affect the trial balance. So let's look at these errors one by one. Now, errors that do not affect the trial balance. Remember, what kind of errors are these? Errors that you make and the trial balance will still what? Balance. Errors that do not affect the trial balance. So the totals, okay, the simple explanation of these: errors that you make and the trial balance will still balance. Errors that you make and the trial balance will still balance. The first error, there are about 6 or 7 errors. The first error is called error of omission. The English word omission, it means you are supposed to record something and you did not record, you forgot to record. For example, if there was credit sales of 50,000 and you forgot to post that transaction, you forgot to post the sales and you forgot to post the receivables. In that case, it's an error of omission. Here, a transaction is completely omitted from the accounts, and therefore the double entry is not made. We don't make the double entry. Example, I've given an example. A sale invoice of 400 is not posted in the sales what? Journal. Therefore, no entry is made in the debtors what? Account and the sales account. You forgot to make posting of sales in credit. So you did not post the sales account and you did not post the receivables or debtors account. Receivables is also called a debtors account. That is, both the debit in the debtors account and the credit of 400 in the sales account is not posted. So how do we correct this error? Remember, it was 400, 400. So there is an account to be debited and there is an account to be credited. So remember, the correct entry was supposed to be debit receivables or debtors and credit sales. So you just come and debit receivables or debtors and you credit sale with the amount that you forgot to record. The second type of error. So what is an error of omission? Where you forget to record a transaction in both the debit and the credit. The second type of error is an error of commission. An error of commission is where the mistake is made in the name account. For example, you sold something to Charles O. You sold something to Charles O as a customer, but you mistakenly posted the entry to Charles F. So which means you have two customers. There was a customer called Charles O, and there's a customer called Charles F. So you posted the error in you posted the transaction in the wrong name account, in the wrong person account. That is an error of what? Commission. This error occurs when a transaction is posted in the wrong account, but the account is of the correct class of what? Account. So both Charles O and Charles F are customers. They are receivables. Example, a credit sales to T Theory is posted to L Theory. So we made the posting to a credit sales was made to T Theory, but we mistakenly posted it to L Theory, just like in the example I've given there. And the posting was what? 200. So you debited, was it a sale? Yes. You debited, you were supposed to debit 200 to Theory T, but you debited it to Theory L. So how do you correct that? You just reverse those entries. So you will have debit and you will have what? Credit. Remember, you posted to L Theory instead of posting to T. So what you do in that case, you come and credit L, the correct entry, T Theory. So this is 200 and that is what? 200. The next slide shows the example we have covered. So we are having debit that and credit that. The next error is error of principle. So we'll try to go to error of principle. Now, in an error of principle, this is where the error is made. The error is made in the class of accounts. What do you mean by class of accounts? We have classes: assets, liabilities, income, expenses. So instead of posting the entry in the assets account, we posted the entry in expenses accounts. Remember, both the assets and expenses, they are both debit entry. So you posted in the expense instead of posting in the assets account. So what do? You reverse the entry. What was posted wrongly is credited, and if it was an expense, you credit the expense and then you debit the asset. The next slide, the next one. So this gives us to the next error is complete reversal of entries. A transaction, complete reversal, entries have been reversed. What was supposed to be debited has been credited, and what was supposed to be credited has been debited. So that is complete reversal of entries. So what you were supposed to debit, you credited, and what was supposed to be credited, you debited. So how do you correct? What was debited will now be credited, and what was credited will now be debited to correct this error. So to correct the error, I've already explained that. So the next error, the fifth error, is error of original entry. Now, here a transaction is posted to the correct account, but the amount posted is not what? Correct. Maybe you are supposed to be posting 980, and you posted what? 890. So you understated your posting by a difference of 90. So if you underposted, that is called, if you understated, we call it an undercast, understated. But in another case, you will find a case where you were supposed to record this, but you recorded more. So if you recorded less, it's an under. You will add when correcting. If you posted more, you will less when correcting it. Next error, compensating errors. Compensating error is where an error has been made, maybe in the assets account, maybe in the sales. We understated sales by 1 million. And then you find also capital was overstated by 1 million. So sales and capital are on the credit side. So capital was understated by 1 million. or overstated by 1 million. If capital was overstated by 1 million, you find that sales was understated. That's compensation, and there's a clear explanation on how we correct it. The next error is the type of error. Remember, we have two types of errors. Now we have errors affecting the trial balance. Under errors affecting the trial balance, these are errors that will make the trial balance not balance. These errors may be caused by one of the following. Number one, transaction amount is posted only on one side of the account. Remember, every transaction should be on the debit and credit. So if you posted only on the debit and forgot to post on the credit, the trial balance will not balance. Number two, a transaction is posted only on one side of both what? Accounts. You are supposed to be posting debit and credit, but you debited and debited. So the debit side will be overstated. The debit side will actually double. Number three, a transaction is posted correctly following the double entry, but different what? Amounts. On the debit, you posted 1 million. On the credit, you posted 100,000. In that case, this causes errors that affect the trial balance. So, number four, error on the balancing of the accounts. When getting the total balances, instead of writing 50,000, you wrote 30,000. And lastly, second last, balance on an account is shown on the wrong side. And lastly, a balance is omitted from the trial balance, not from the ledgers, from the trial balance. Our next, now, these errors are corrected by preparing a suspense account. By preparing a suspense account. So a suspense account in account showing a balance equal to the difference in the trial balance. For example, if the total on the trial balance was 1 million debit and the total on the credit side was 800,000. So debit is more than credit. There is a difference of 200,000. That 200,000, we create for it an account called a suspense account. So in a future unit, we'll look at this example, how to correct that, how to prepare, a suspense account. Where the balance is where you post the suspense account. Finally, there is what we call preparation of financial statements. From the trial balance, the results of the trial balance will lead us to preparation of financial statements. There are two financial statements you need to know how to prepare. Number one, statement of financial position, and number two, statement of profit or loss. We normally start with statement of profit or loss, which shows the financial performance. In this, you need to know what are your incomes, what are your expenses. It shows your income and expenses. We had already defined these two in the previous unit. Balance sheet, statement of financial position. What do we have? Three items: assets, liabilities, and capital. We had already defined them in a previous unit, unit number 2. When we are finishing financial statements, we started by looking at this process. The process must end with preparation of financial statements. It starts with transactions, source documents, day books. We had already explained this when we started. So source documents, day books, ledgers, trial balance, financial statements. 2 questions as we wind up. The first one: which of the following is an example of an error of commission? Remember, an error of commission is an error that affects the name of the account. A receipt, name of the account. A receipt of 25,000 from JG is entered in GJ's account as credit and debit to cash. So this affects the name. We were supposed to be posting it in JG, but we posted in GJ's. So that affects the name. That is an error of commission. We don't even need to look at the others. The last question: completing, okay? So which one of the following errors would be a possible reason? Which of the following errors would be a possible reason for the trial balance failing to agree? Errors affecting the trial balance. Which errors? Remember, errors affecting the trial balance, we said they mostly lead us to the preparation of suspense account. Sales of 500,000 entered correctly, but entered as 1.5 million in the receivables ledger control account. So in the receivables ledger control account, we were supposed to be posting 500, but we posted 1.5 million. It will not agree. There will be a difference of 1 million. So the answer is A. A purchase of 550,000 on the credit not being recorded. Remember, this is an error of omission. It will not affect the trial balance. Cash wages being recorded as debit and credit that. So debit that and credit that. So remember, this is complete reversal of entries. And lastly, an asset purchase of 750,000 being recorded as a debit. Machine repairs 750 and credit. So an asset purchase of 750 being recorded as debit machine repairs. Machine repairs is an expense, yet this is an asset. This is an error of principle, an error that affects the class of accounts. And that brings us to the end of this unit. Brings us to the end of unit 4. Thank you, and let's meet in unit 5.